You've reset more times than you can count. Not because your setups are bad, but because you're trading like someone you're not. The problem isn't your strategy. It's that you've been following someone else's blueprint. You're trading in a style that doesn't match who you actually are as a trader. And that mismatch is exactly why you keep blowing the account. This is part 1 of the advanced masterclass. If you've reset more than twice, you need this. Here's the fix. Stop trying to trade like someone else. Your natural rhythm, your trade frequency, hold time, and risk tolerance, those aren't just preferences. They're your trading blueprint. And if they don't align with the eval structure, you've got 2 choices. Adapt your execution, or choose account parameters that support your edge. Most traders never consider this. They see someone pass with aggressive scalping and try to mimic it, even though they're naturally conservative. Or they try to trade with a slow, patient mindset in a fast-paced format, missing setups, second-guessing, and falling behind. That internal conflict? That's what makes it feel so hard. You're fighting yourself and the eval rules. Here's how to diagnose the mismatch. Track your last 50 trades. What's your average trade frequency? How long do you typically hold? What's your longest losing streak? Those answers reveal what kind of account structure matches your style, not just your goals. If you're high frequency with tight stops, you need more attempts before hitting max drawdown. If you're low frequency with wider stops, you benefit from larger account buffers since you're not burning through trades quickly. Here's something most traders get backwards. Bigger isn't always better. Yes, the 100K account doubles your size compared to 50K, but you often need to hit 140% more profit with only 50% more room for error. Your account size should reflect your edge metrics, not your ego. On a 25K account with a $1,000 max drawdown, risking $50 per trade gives you 20 attempts. On a 50K account with a $2,000 drawdown, risking 100 also gives you 20 attempts. Same opportunity count, but the smaller account creates less psychological pressure. Scalpers taking 8 to 12 trades per day need that margin for error. One bad morning, and you've already used 5 trades. If you're risking 5% of your drawdown per trade, you survive. If you're risking 15%, you're done before lunch. Traders taking 1 to 2 trades per day, you can manage a larger account. You might risk 200 per trade on a 50K eval, but only take 6 to 8 trades during the entire challenge. The math works because your win rate and R multiple per trade are higher. Let's talk about the 3 personality mismatches that kill evaluations. Pattern 1. The natural scalper in a constrained environment. You're built for volume. 20 trades a day feels natural, but in a challenge, that multiplies your error rate. Every trade becomes a chance to force something, break a rule, or revenge trade. The fix? Choose a larger account to get more total drawdown, but risk less per trade. On a 50K account with a $2,000 drawdown, risking $50 per trade gives you 40 attempts. That's twice the breathing room. Or if large accounts stress you out, run multiple smaller accounts in parallel. Same risk per trade, but spread across accounts, so there's less pressure on any single one. Pattern 2. The patient trader in a fast-paced format. You prefer to wait for clean setups, let trades unfold, and only act when everything lines up. But in a prop firm evaluation, the clock is ticking. There's a fixed number of days and a limited drawdown. You hesitate, miss entries, and second-guess setups, then feel pressure to make up for lost time. It's not that your approach is wrong. It just doesn't align with a structure that rewards timely execution and decisive action. The fix: focus on quality over frequency. Accept that you won't trade every day. Build your plan around fewer, high-conviction setups with defined criteria. Let the strength of your edge do the heavy lifting, without trying to force activity just to stay on pace. Pattern 3. The slow bleeder. You're cautious, 3 or 4 trades per day. Losses slightly outweigh wins. By day 10, you're down 1,200. Panic sets in. You start pressing. By day 15, you hit max drawdown. You're not a bad trader. You're just using a conservative approach in a format that rewards controlled aggression. The fix? Don't ramp up trade count. Ramp up trade quality. 3 solid trades with proper sizing beat 10 weak ones. And consider passing multiple smaller accounts with the same strategy. Instead of one 50K account, pass 3 25Ks and run them in parallel. You don't triple your leverage, but you do increase your total drawdown buffer and flexibility. If one account hits a limit, the others can keep going. You're spreading your risk without adding pressure to a single account. And hey, if size really matters to you, you can always scale up to 50K accounts later. Crawl, walk, pass the eval, then flex. Here's the framework. Before you buy another eval, know your natural trade frequency, average hold time, stop size comfort zone, and longest losing streak. Then reverse engineer your account size and risk per trade. If your longest losing streak is 8 trades and you take 5 trades a day, you need the room to survive 10 straight losses without hitting your limits. The goal isn't to size up, it's to size smart, in a way that rewards your blueprint, not punishes your tendencies. A funded 25K account is worth far more than a failed 100K eval. And once you pass that 25K, multiply your edge across accounts using trade copier tools. 3 funded 25K accounts give you $75,000 in buying power. Less leverage than a single 100K account, but with distributed risk and less pressure per trade. The traders who pass and stay funded aren't forcing themselves into someone else's system. They're choosing the structure that fits who they already are. Bottom line, stop trying to trade like someone else. Your rhythm, your risk tolerance, your trade frequency, those aren't weaknesses. They're clues to your edge. The question is whether your account structure amplifies your strengths or punishes your style. This is part 1. In part 2, we'll cover what to do after you understand your blueprint, how to adjust in real time during the eval, why firms create these rules from an institutional perspective, and what separates traders who stay funded from those who pass once and blow up. If this unlocked something, hit like and subscribe. You're clearly past the beginner stage and ready for advanced content. Check the links below if you're serious and want tools for charting, journaling, analytics, mindset, and scaling capital. Order filled, helping you see the game clearly so you don't get played. Educational only, not financial advice. Futures trading carries risk. Protect your capital.